More than 2.5 million Californians are already behind on their mortgage or property tax payments. And experts warn that by 2026, many could be forced to sell their homes just to stay afloat. It sounds unbelievable, doesn't it? The same state that once symbolized wealth, sunshine, and opportunity is now pushing homeowners to the edge of financial collapse. Property taxes are climbing, insurance companies are pulling out, and mortgage rates are resetting at record highs. Even those who thought they were safe middle-class families, retirees, and new homeowners are realizing they're sitting on ticking time bombs. The truth is, California's housing crisis isn't slowing down, it's accelerating. And for millions, 2026 might be the year their dream home turns into their biggest nightmare. Number 1. The property tax time bomb. For decades, Californians believed that Proposition 13 was their safety net, a promise that property taxes would stay predictable and affordable. Passed in 1978, it was meant to protect homeowners from skyrocketing assessments, capping annual increases, and giving families stability. But that promise is quietly eroding across the state. County assessors are reinterpreting the law, introducing adjustments, local measures, and voter-approved exceptions that slip through legal loopholes. The result? Property taxes are rising. Not dramatically all at once, but in slow, calculated increments that few people notice until it's too late. By 2026, many of these measures will take full effect, meaning millions of homeowners could see their annual tax bills double or even triple, especially in counties like Los Angeles, Santa Clara, and San Diego. What makes this situation so dangerous is how subtle it's been. Cities are desperate for revenue to fund infrastructure, schools, climate projects, and pensions. And property taxes are the easiest target. Unlike income taxes, they can't be avoided or deferred. They come due every year, no matter what happens in the economy. Retirees living on fixed incomes are particularly vulnerable. Many bought their homes decades ago when taxes were manageable, but now find themselves facing bills that rival their mortgage payments. For younger families who stretched to afford a home during the pandemic boom, even a small increase could be devastating. Behind closed doors, state lawmakers are already debating proposals to modernize Proposition 13, a phrase that sounds harmless but could permanently change how California taxes property. Critics call it the slow repeal, a series of policy shifts that could dismantle protections piece by piece. For the average homeowner, it means one thing: uncertainty. What was once a predictable expense is becoming a moving target. Psychologically, this shift hits harder than most realize. Home ownership has always represented stability, a sense of safety against the chaos of rent hikes and inflation. But when your property tax can rise faster than your income, that foundation begins to crumble. Stability turns into stress. Ownership turns into a gamble. And for millions, the home they worked their entire lives to keep may soon be the very thing that pushes them over the edge. The time bomb isn't coming. It's already ticking. Number 2, the insurance collapse. California's homeowners are facing a new kind of disaster, one that doesn't come from wildfires, earthquakes, or floods, but from the companies meant to protect them. Over the past few years, major insurers like State Farm, Allstate, and Farmers have either pulled out of the state entirely or stopped issuing new policies. The reason? California has become too expensive to insure. Skyrocketing rebuilding costs, record wildfire payouts, and state regulations that cap premium increases have made it financially unviable for insurers to stay. What this means for homeowners is simple but terrifying. Even if you've never filed a claim, your premiums are likely to skyrocket. Your coverage could vanish overnight, or you could be forced onto the state's emergency insurance pool known as Fair Plan, a last resort option that costs more and covers less. For decades, insurance was the invisible safety net that made home ownership possible. It's the piece of paper that stands between a house and total ruin. But now that paper is disintegrating. In some parts of California, especially rural or high-risk zones, premiums have tripled since 2021. Homeowners who once paid $2,000 a year are now receiving renewal quotes for $7,000 or more, if they can even find coverage at all. Others are being dropped without warning, receiving letters that say their policies won't be renewed due to catastrophic risk. Ironically, many of these areas haven't seen major fires in years. The crisis isn't just about risk, it's about profitability. Insurers can make more money elsewhere, and California's strict consumer protection laws make it easier to walk away than to adapt. This growing insurance void has created a chain reaction. Without coverage, homeowners can't refinance their mortgages or qualify for new loans. Buyers avoid uncovered properties, leading to declining demand. And when demand falls, prices follow. It's a slow-motion market freeze, one that quietly chips away at property values and homeowner confidence. The emotional toll is immense. People who once felt secure now live in fear that a single spark, storm, or letter from their insurer could destroy everything they've built. The dream of homeownership has always been tied to the promise of protection. But in California, that promise is collapsing, leaving millions exposed, anxious, and wondering how long they can hold on before the system itself burns out. Number 3. Mortgage rate shock. In 2020 and 2021, Californians rushed to buy homes in what felt like the opportunity of a lifetime. Historically low mortgage rates, flexible remote work, and the belief that real estate would only rise in value. But the honeymoon is ending. As interest rates climb to their highest levels in decades, thousands of homeowners are now facing the financial shock of their lives. Many of them didn't lock in long-term fixed rates. Instead, they took out adjustable rate mortgages, ARMs, or short-term refinances with low introductory terms. Those terms are now expiring and payments are beginning to surge. By 2026, millions of these homeowners will see their monthly mortgage costs jump by hundreds, even thousands of dollars. What once felt affordable is suddenly impossible to maintain. The situation is particularly dire for those who bought during the pandemic peak. They stretched their budgets, often paying above asking prices in bidding wars, assuming low rates would keep the dream manageable. Now they're trapped, unable to refinance because of higher rates, and unable to sell because property values are dipping. Economists are calling it mortgage whiplash, a condition where homeowners are simultaneously too broke to stay and too indebted to leave. The result is a growing number of Californians living paycheck to paycheck just to hold on to houses that no longer feel like assets. This phenomenon is eerily similar to what happened before the 2008 housing crash, but this time it's quieter, slower, and more psychological. Instead of mass foreclosures, it's mass fatigue. Families cutting back on essentials, skipping repairs, or working multiple jobs just to cover rising payments. The emotional weight of this pressure is immense. The house that once symbolized success now feels like a financial trap. An anchor pulling entire families under was Adair. Banks, too, are becoming more cautious, limiting refinancing options and tightening lending standards. That leaves homeowners without escape routes, watching helplessly as interest resets eat into their savings. It's not just a financial problem, it's an emotional unraveling. When people realize their homes own them instead of the other way around, something deeper breaks. By 2026, that realization could become widespread, sparking a quiet wave of forced sales as Californians trade pride for survival, one mortgage statement at a time. Number 4, declining property values. For years, California's housing market seemed unstoppable. Prices soared, investors poured in, and homeowners watched their equity climb as if the Golden State could never lose its shine. But the tide is shifting and fast. Across the state, property values are quietly slipping, creating a growing sense of unease among those who once felt untouchable. In places like the Bay Area, Sacramento, and Los Angeles County, home prices have already dropped by 10 to 20% since their pandemic-era peak. For homeowners who stretched their finances to buy during the frenzy, that drop isn't just disappointing, it's devastating. Many now owe more on their mortgage than their home is worth, a condition known as being underwater. And when that happens, panic sets in. The causes are complex but connected. Rising mortgage rates have frozen the market. Potential buyers are priced out, and current homeowners refuse to sell, creating a standoff that weakens demand. Meanwhile, tech layoffs, remote work migrations, and population decline have drained California's once bustling housing hotspots. Fewer high-income earners means less competition, and less competition means falling prices. Investors, too, have begun retreating, shifting focus to states with lower taxes and higher rental yields. The golden property boom that once seemed infinite is beginning to look fragile, a bubble stretched thin by speculation and debt. What makes this downturn especially troubling is how psychological it's become. Real estate in California has always been more than an investment. It's identity. People bought homes not just for shelter, but for status, pride, and a sense of progress. When values fall, it doesn't just affect balance sheets, it affects morale. Homeowners start cutting corners, delaying maintenance, and silently dreading the next appraisal notice. The illusion of wealth fades, replaced by quiet anxiety. For retirees, declining values means shrinking equity, the savings they counted on for their future disappearing into thin air. For new homeowners, it means feeling trapped in a bad deal, unable to move, refinance, or recover. And for the broader economy, falling home values mean lower consumer spending and fewer tax revenues, creating a domino effect that hurts everyone. The truth is, California's housing market doesn't need a dramatic crash to cause pain. A slow, steady decline is far more dangerous. It eats confidence, corrodes hope, and leaves millions questioning if the California dream was ever real at all. Number 5. New state and local fees. For years, California homeowners have accepted high taxes as part of the price for living in one of the most desirable states in the country. But what's happening now goes beyond taxes. It's a quiet financial ambush hidden inside new fees, surcharges, and impact assessments that most people don't even notice until the bills arrive. Across the state, city, and county governments are introducing dozens of new charges tied to property ownership. Infrastructure maintenance fees, wildfire protection assessments, environmental impact contributions, school parcel taxes, and climate resiliency surcharges. Each one sounds small and reasonable on paper, but together they create a relentless financial pressure that's slowly crushing the average homeowner. The logic behind these fees is simple. California's cities are broke. Years of budget deficits, pension obligations, and deferred infrastructure maintenance have left municipalities desperate for cash. Instead of raising headline taxes, they quietly slip in localized fees that require only limited voter approval, or in some cases, none at all. What was once a $200 annual neighborhood levy can suddenly become a $600 climate adaptation fee without residents realizing what changed. And because these charges are recurring, they accumulate over time, tightening the noose a little more each year. By 2026, many of these policies will be fully enacted, pushing even stable homeowners into financial strain. The most dangerous part of this creeping cost is its invisibility. Homeowners rarely connect these small charges to their broader financial stress. They budget for the mortgage, the insurance, the utilities, but not for the dozens of hidden deductions that quietly appear under the label of community improvement. The cumulative effect is staggering. A few hundred here, 1,000 there, until suddenly families find themselves wondering where their money went. For retirees and working-class families, these new fees can mean the difference between staying in their homes or being forced to sell. Many live on fixed incomes that can't absorb constant new expenses. The tragedy is that most of these homeowners support the goals these fees claim to fund. Safer neighborhoods, greener cities, stronger schools, but they simply can't afford to finance them. In a state that already taxes income, purchases, and property, these layered fees are like the final straw on a weary back. They don't make headlines, but they quietly reshape lives. One small, unnoticeable deduction at a time. Number 6, the aging infrastructure crisis. California's beauty hides an uncomfortable truth. Much of its infrastructure is old, fragile, and dangerously outdated. Roads, bridges, power lines, water systems, and even homes built in the mid-nth century are reaching the end of their intended lifespans. But instead of steady maintenance over the decades, neglect and budget shortfalls have left much of this infrastructure to decay. Now the bill for decades of underinvestment is coming due, and it's homeowners who are being forced to pay it. In the coming years, particularly by 2026, state and local regulations will require property owners to make costly upgrades to meet stricter safety, environmental, and energy standards. These mandates include seismic retrofitting, electric panel updates, green energy compliance, and water conservation modifications. While these reforms may be necessary, they are financially devastating for ordinary Californians who already live on the edge. Take, for example, seismic safety. Thousands of older homes, especially those built before 1980, need costly retrofits to withstand earthquakes. Depending on the structure, those upgrades can cost anywhere from $10,000 to $50,000 out of pocket. Then there are new green energy requirements which demand solar installations, heat pump systems, and electric vehicle-ready wiring for certain renovations or property sales. These eco-conscious goals may look good on policy papers, but for the average homeowner, they can turn a small repair into a financial nightmare. A simple roof replacement might now require a solar setup, driving costs into the tens of thousands. Homeowners are caught in an impossible dilemma: comply and drown in debt, or delay and risk penalties or insurance cancellations. Many are already receiving notices warning of upcoming code enforcement deadlines, particularly in older communities across Los Angeles, San Bernardino, and the Central Valley. For retirees or longtime residents living on fixed incomes, these mandatory improvements are nothing short of forced spending. And because home values are softening, few can recoup those costs if they decide to sell. The cruel irony is that these reforms, while intended to create safer, greener communities, may instead accelerate displacement. Wealthier homeowners can adapt, but working-class Californians are being priced out of compliance. Their homes, once their pride and stability, are turning into financial liabilities under a system that rewards regulation over reality. By 2026, California may not just be upgrading its infrastructure, it may be unintentionally dismantling the very communities that built it. Number 7, the exodus of buyers. For decades, California's housing market thrived on one essential ingredient: demand. As long as there were buyers flooding in, prices climbed, investments flourished, and homeowners felt secure. But over the last few years, that steady stream of buyers has begun to dry up, creating a dangerous shift in the state's economic balance. The combination of high interest rates, inflated prices, and dwindling affordability has scared off an entire generation of potential homeowners. Young professionals, once eager to settle down in California, are now leaving the state in record numbers. Between 2020 and 2024, more than 800,000 residents moved out, taking with them the demand that once kept the market alive. The result? Homes are sitting longer on the market, price cuts are becoming common, and once crowded open houses are eerily quiet. This decline in buyers has triggered a ripple effect across the entire housing ecosystem. Builders are halting new construction projects. Real estate agents are struggling to close deals. And property tax revenues are falling, leaving local governments even more desperate for funds. Meanwhile, investors who once snapped up California real estate for profit are redirecting their money to states like Texas, Arizona, and Florida, where costs are lower, regulations are lighter, and returns are higher. The vacuum left behind isn't just economic, it's psychological. When people stop believing that California real estate is a guaranteed win, confidence collapses, and confidence is what fuels markets. For homeowners who bought during the boom years, this shift is alarming. They're discovering that selling isn't as easy as it used to be. The bidding wars are gone, replaced by cautious buyers demanding concessions and price reductions. Many homeowners are learning that the equity they thought they had is vanishing as the market cools. And those who depend on rental income to cover their mortgages are facing rising vacancies as more tenants leave the state altogether. The most unsettling part of this exodus is its self-reinforcing nature. As more people leave, demand falls further, prices dip more, and fear spreads. It's not a crash in the dramatic sense. It's a quiet unraveling, one that creeps rather than explodes. California's housing market has always been built on the promise of endless growth. But growth needs believers. And right now, millions of Californians are losing faith in a system that no longer believes in them. Number 8, the 2026 correction window. Every financial cycle has a breaking point, and for California's housing market, Experts warn that 2026 may be it. Economists, lenders, and real estate analysts are quietly predicting what they call a correction window, a period when multiple economic pressures collide to trigger a mass sell-off. Unlike the sudden crash of 2008, this correction won't come as an explosion. It will unfold like a slow bleed fueled by years of silent instability. Rising property taxes, ballooning insurance premiums, expiring mortgage rates, and declining property values are all converging around the same time. By late 2025 through mid-2026, analysts believe thousands of homeowners will reach a breaking point. Realizing that keeping their homes simply isn't sustainable anymore, the setup for this collapse has been building for years. During the pandemic, many Californians bought homes at inflated prices with historically low interest rates, believing they had locked in security. But as rates rose, inflation persisted, and home values began to soften, that security began to crumble. Now, homeowners are carrying record amounts of debt while their equity quietly evaporates. Add to that the state's tightening regulations, rising energy and maintenance costs, and the shrinking pool of buyers, and the stage is set for what some economists call forced liquidation. Homeowners won't sell because they want to. They'll sell because they have to. The banks see it coming too. Many lenders are already preparing for a wave of refinancing failures and delinquencies. They know that by 2026, the adjustable rate mortgage resets and expiring forbearance programs will collide, creating a spike in distressed listings. Investors are also watching closely, holding back from new purchases until prices fall, a self-fulfilling prophecy that will drive values down first. This isn't speculation, it's math. The psychological aspect may be even more devastating than the financial one. For millions, selling a home isn't just losing a property, it's losing a sense of achievement, pride, and belonging. California has always been marketed as the land where dreams come true. But 2026 could mark the year many realize that the dream has quietly been repossessed. The correction won't just reshape the market, it will redefine what homeownership means in the Golden State, turning the California dream into something far more sobering. The California lesson. So, what do you think? Is California heading for a slow collapse or just another cycle in disguise? Share your thoughts below. I want to hear your take on where this all leads. If you haven't watched our previous video, go check it out. It connects directly to the story. We pour countless hours into research and production to bring you the truth behind the headlines. So, if you'd like to support us, hit that subscribe button. It's just one click, but it means everything to